Hello and welcome to the week ahead with me, Fiona Sincota, Senior Market Analyst at City Index. And we are here to do the week ahead. I can't believe it's already the 5th of December, but we will be looking at the week commencing the 8th of December. So as always, I'm just going to ask you to have a quick look through the risk warning. I'll put myself on mute whilst Okay, so without further ado, let's just have a quick look at what is going on. So as always, we tend to start with a quick look at how the week has progressed. S&P 500 actually just very modestly higher. We've seen, as we've saw a solid recovery from that low that was across the end of just November, solid recovery, but that recovery is now just very much grinding higher as the market has been supported by expectations that the Federal Reserve will cut interest rates next week. But it's worth keeping in mind that there are a couple of risk events over the next 2 weeks which are worth keeping an eye out for before we get sort of into the throes of the Santa rally or not, and sort of the Christmas period. So next week, the main focus is on the Fed. The markets this week have been supported by expectations that the Fed will cut rates. We've seen ADP payrolls came in well below expectations, down 32,000, weakest reading in 18 months. We saw the Challenger job cuts. Layoffs were 71,000, not as bad as expected, but 1.1 million total layoffs across the year does point to a weaker jobs market. The market is, as I said, pricing in around an 87% probability that the Fed will cut rates next week. And so all this data has been sort of supporting those expectations. And that's sort of why we've seen perhaps a level of caution, though, as well, ahead of next week. There have been some data points that were stronger than expected. We saw initial jobless claims showing that claims were at the lowest level in 3 years, down at 191,000, but this was across the Thanksgiving period, so it's worth keeping in mind that the data can be quite volatile around that time, so because of the holiday. So one data point is definitely not the start of a new trend. We're still not getting non-farm payroll report. That would have been released today, but it's not coming through because of the US government shutdown. What we are seeing is US core PCE for September, so the delayed report, which is due out today, which again, it could offer some insight into the state. Well, it will offer some insight into the state of inflation. And we know that the Fed is worried about sticky inflation. So it is something that could sort of not necessarily dampen expectations surrounding a rate cut next week, but potentially could mean that we're seeing less easing in 2026 if that inflation remains sticky. So as I said, US stocks were pretty much just a tad higher. The US dollar was actually weaker for a second straight week against its major peers. It's still below that 200 SMA there, and we've fallen below the 50 SMA as well. So pretty two key levels that we're just watching out for. So just to talk about sort of the what we're expecting next week, as I've touched on already, actually, the Fed. Sorry, before we go on to that, just talk about one other thing that actually has been a major topic, but there hasn't necessarily been any data surrounding it, is what's going on in Japan. So I think this is the other area that going into next week, we still need to keep our eyes very much on Japan, particularly to do with Japanese bond yields. Japanese bond yields have risen. The 10-year bond yield rose to its highest level since 2007. And we're just basically seeing some concerns surrounding the unwinding of the yen carry trade as well. We've got the Bank of Japan meeting on December the 18th, where the BOJ is widely expected, or 86% priced in, should I say, to hike rates. Interesting what will be here is whether they hike rates and hint to further hikes, because what this could mean is a really seismic shift in the way things have been. We have previously seen sort of, you know, Japanese bond yields very low, very steady. We'd seen the yen again weak because of, you know, lower interest rates, and that supported the carry trade where investors borrowed in the low interest rate yen to invest into riskier assets, particularly US tech and crypto. That's the areas where you can see it, but in a lot of places across the market. So if there's suddenly the Bank of Japan is looking like it's going to be hiking interest rates on a persistent basis, that's going to mean that we could see the repatriation of funds back to Japan, which means the unwinding of the carry trade. Now, I don't think this is happening so far, but I think it is a worry that is looming over the market and could potentially come into fruition if we see on December the 18th that the Bank of Japan hikes and points to more hiking. So that's something just to keep an eye out, and I think that's also just been, you know, weighing on the market. It's not provided any steep sell-off, maybe a little bit more in crypto than in other areas, but that's what we're seeing. So just as far as technicals are concerned with the S&P 500, we've seen that recovery from the 6,500 low back into the rising channel, back above the 50 SMA, back above the 6,800. Next level to be looking out for 6,930, which is the record high, and above that then obviously 7,000. So just watching here, we're seeing the RSI breaking above this suggestion of a bearish divergence on the RSI. So if we get a break above that as well, that could mean that we could see potentially more gains if momentum is behind the S&P 500. But that, I think, would depend a little bit on the Federal Reserve. As I said, I think we are going to see a hawkish Fed cut. There is a good chance, because we've got this division in the Fed. It's not that all policymakers are necessarily in support of further rate cuts from here because of concerns over sticky inflation. So maybe in order to appease those more hawkish members, Chair Powell is going to go for that hawkish cut, which, if we see expectations for rate cuts in 2026 ease, then that could obviously pull the S&P 500 a little bit lower, which would raise some questions over whether we will see the Santa rally towards the end of the year. So just this is the economic calendar. I'm just going to filter it for next week so we can have a look to see what else we have on, and then we're also going to filter it for the more high volatility releases so we can have a look. Obviously, we've spoken about the Fed. We've got GDP for Japan as well, just at the start of the week. So that is expected to show that GDP is coming in slightly weaker than previously. And I mean, that could, if we do get weaker than expected or some signs of weakness in the Japanese yen, that could then give some lift to the US dollar Japanese yen pair, especially if we find that, you know, there is some expectations of that hawkish cut from the Fed. Just having a look at the chart here, I mean, we saw that the USD Japanese yen rose out of that rising channel, rose to a high of that one at 57.90, has been falling lower ever since. testing the 155 here. Interestingly, just have a look at the hammer candle. I mean, we'll have to check what it's like at the end of the day, but that's looking like a hammer candle right now, which could suggest a reversal pattern, in which case buyers may be looking to move up to 156. That's the December high, and above that, the 157.80, which was the high that we saw in November. And if we do get above those, then obviously then we need to be thinking about intervention as well. So there are a lot of factors in play as far as Japan is concerned. Then on the downside, if we do get a break below that 155, supposing you get stronger than expected growth in Japan, then be looking for the 153.20 level. It's the 50 SMA. It's also the high that we saw at the beginning of October. So RBA do have their interest rate decision as well. Okay, now the RBA left interest rates unchanged in the November meeting at 3.6%. Here we go. Just getting a breakout on the Aussie dollars. This is something to be watching here. So just as far as the RBA is expected, left rates on hold at 3.6%. That was in line with expectations. Okay, so there was no surprises there. And the decision was also unanimous, driven basically by a pickup in underlying inflation in the September quarter. And in the monthly monetary policy statement, the RBA actually lifted its inflation forecast with a trimmed inflation mean expected at 3.2% until mid next year. Now it's only returning to that 2.5 midpoint target in 2027. So as a result, we're not really expecting the RBA to be cutting interest rates anytime soon. They're expected to leave them on hold at 3.6%. And I think, you know, attention will be very much on how the RBA communicates this run of data that we've seen. I think very much expecting to stick with its sort of data-dependent stance. Obviously, what's interesting here is the Fed, which could be looking to cut, and then the RBA, which is very much looking to hold. Levels to be watching here, we're breaking up above it, 166.20. This is the level that's like held the pair back on numerous occasions. So a sort of close above this level really does bring the 67 high for 2025 into focus. And you know, that's going to be the next level on the upside to be watching for. RSI supports further upside while it remains out of oversold territory. Just as far as levels on the downside to be watching, as I said, you've got the 66.20, and then below that you've got this level here, which is the 65.40 level. That's the 50 SMA. And it's also the falling trend line support, so that could be quite a key level, and I think a break below that sort of negates that near-term breakout as well. So that's the RBA to be watching. We've also got Chinese inflation data to be watching. A lot of central bank decisions. We've got the FOMC, which we've been already speaking about. Let's just have a quick look at gold as far as that's concerned as well. So I think, you know, this is interesting what we're seeing here. It's we're getting sort of a bit of a breakout, but it's not quite happening. So if that makes sense, we just need to sort of keep our eyes and ears focused a little bit on oopsie daisy, what's going on here. So let's just get rid of this, because that we can see then a little bit clearer. So we broke out of this symmetrical triangle, but the breakout's just consolidating very much around that sort of 4,200, 4,250 level, okay, potentially gearing up for further upside supported by the RSI. But we need to wait and see. We need really a move above that 42.50 level, 4,250. We a close above there to be able to bring the 4,380 record high back into focus. On the downside, be watching for a break below the 4,200, which seems to be a pretty solid support at the moment. If we get a break below that, then that's going to bring sort of this 4,050 level into focus, and obviously 4,000, which is the round number. Obviously, with gold, what are we watching here? We're seeing the weak US dollar has offered a little bit of support, expectations for further rate cuts offering some support. Let's see what's going on with inflation, though, because if inflation does show signs that it's starting to come down, then that might just take some of the shine away from gold, that it's, you know, the inflation hedge that it is. But I think as far as the outlook is concerned, you know, central banks are still buying gold despite being sort of, you know, record high prices in Q3. We still saw gold purchases by record banks really high, which will be offering support to the precious metal. And then we've got ongoing geopolitical tensions. I mean, you know, what's going on in Russia and Ukraine, moving towards peace, but, you know, still nothing really in writing and agreed. And it does seem to depend on, you know, some days they're about progressing with a peace trade deal, and sometimes they're not. So, you know, there are still geopolitical tensions to be keeping an eye on. But I think broadly speaking, you know, to do with Fed rate cut expectations, the US dollar, and ongoing central bank purchases, potentially over the longer term, gold does remain supported. Those are the levels to be watching. Let's have a look what else we have. Okay, so we've also got a speech by, we'll stick to some UK stuff. We've got a speech by Bailey, and we've also got UK GDP data. So as far as UK GDP data is concerned, GDP actually fell 0.1% month on month in September, and that was below expectations of 0% growth. And that's partly due to that cyber attack disruptions at Jaguar Land Rover. However, more recently, the PMI data, we saw November PMIs were actually revised higher to 51.3, up from 50.5, but that was still down from October, suggesting that there was some cautious sentiment heading towards the Chancellor's budget. Now, obviously, GDP data is relating to October, so again, this was before the Chancellor's budget, and we were seeing signs of caution. So expectations are for GDP to be flat in October, and that really does support expectations that Bank of England will cut interest rates again by 25 basis points in the December meeting to 3.75%. This is the pound. We have seen the pound interestingly recover from those lows that were sort of pre-budget lows. The pound was supported. We saw gains after the UK budget, but I think those gains were more of a relief rally rather than because there are particularly strong fundamentals in the UK, especially given that the Bank of England is expected to cut rates again this month. So we've seen that rally testing support there at the 135.60 level, as we expected it to do, which is also just above the 200 SMA. RSI is pointing higher. So if we do get sort of, you know, weakness today in those US inflation data, or a more dovish sounding Federal Reserve, which helps to support cable, then we could get a break above that 133.60 level. And that then brings in the 134.85 level, which was the October high, back into focus. 135, well, it was around the high in October, wasn't actually the high in October. Above here, 136. If we're finding that we get weaker than expected UK GDP data, which is going to raise concerns over the health of the UK economy, and we get a hawkish cut from the Fed, that could strengthen the US dollar, and we could find on the downside a break below the 200 SMA at 133.25, opens the door to this level here, which is the 132.50, and below there the 132 level. So I mean, we have recovered though pretty well from those lows, but I think the outlook for sterling is not that great, but given that the outlook for the US dollar is also weaker for now, that does mean that the pair is at least a little bit supported. Just also going to have a quick look at UK 100. Very much, it had been trading in this very strong upward channel. We've recovered from those lows of the 94.25, and we're sort of testing here the 9700 resistance. Very much been in tight range across the week, waiting for that next catalyst, which, as I said, you've got the Fed, you've got the Bank of Japan, you've got the Bank of England. There's quite a lot coming up in the next few weeks. But on the upside level, you'd be looking at 97.90. That was the high that we saw in October as the next level on the upside before we sort of head towards record highs. On the downside, if we find a break below that, sort of fail to move above that 9700, then on the downside, look for 9580 as the next level in line. So that's what we've got going on there. We're just going to have a quick look at oil as well. There we go. So oil is trading in a downward channel. Basically, I mean, obviously ongoing concerns over the oil supply glut in 2026 has kept oil prices under pressure, but we could be starting to see a breakout. We've got this potential bull flag pattern here. If we can get a breakout above this 60 level, round number, 50 SMA, upper band of the rising channels, 2 rising channels. So it's quite a big resistance level that we need to break above. I mean, what we've seen here is that oil prices fell on those sort of optimism that Russia and Ukraine were going to that the Russia and Ukraine were going to agree a peace deal, in which case Russian oil could be would have the sanctions removed and supply would increase. So that sort of caused prices lower in recent weeks. However, now we're seeing this sort of stalling of the final part of such a peace deal. It does mean that actually, maybe this isn't going to happen, and Russia will continue to experience sanctions, which may keep oil supply at least a little bit tighter than what the market was fretting about, even though we still are expecting a supply glut in the coming year. So levels to be watching, really key level 60, and above there we get to 62.50, which was the October high, and then you've got the 200 SMA in there at 63. We are still in a downward trend, but we could be breaking out. Just as far as downside is concerned, 57.20 is the level on the downside. That was the low that we saw in November, and below that 56 will be the other level to watch for. Just going to have a quick look at what's going on in the US tech stocks, because obviously we've had those concerns over US tech stocks, which really weighed on the tech situation just a few weeks ago. But the market seems to have been recovered actually from those concerns over AI bubbles. I think they will still remain. They are still in question every time, especially when we get news of Nvidia buying another company, circular funding, lack of monetization. These sort of concerns continue to linger. But we have seen a recovery in the NASDAQ. Next level, it's running out of steam though. It does look like it's sort of definitely a grind higher rather than a strong move. That potentially is cautious above ahead of next week's Federal Reserve meeting. 26,000, next level on the upside before the record high there of 26,250. On the downside, support can be seen this level here, 25,200. That's the 50 SMA, 25,100, and also the high that we saw back in the beginning of October. They're levels to be watching out for. So that is everything. We had a quick walk through. There is some other events going on next week to also keep an eye out for. We've got, as I mentioned, SMB rate decision. Also got Bank of Canada interest rate decision as well. Thanks very much. We're not here next week. I'm away now until the beginning of January when we will start to do these again. Take care.